Hello, Matthew Copley here with Copley Financial Group, and today we're going to do a market update. We're going to cover what is going on in the economy, what we're seeing with the markets. We're going to talk a little bit about what we see out of the new Trump administration, and we're going to cover some things with our company and things we're seeing going forward. So first, I'd like to talk about what we're doing as a company here in San Diego. There's a lot of changes happening. We're going to be looking for a new office. Our lease is up towards the end of this year, and we're going to be actively searching starting in March for a new location. We've been here at the same spot for the last 20 years, since October of 2004, and so it'll be interesting to potentially move to a new location. And so we're looking at some different areas in San Diego. We're focused on UTC and areas that we might get a little bit nicer of an office than we have now. Of course, parking is going to be really important for us and for our clients, and so that's going to be a focus on any office hunt that we do. So in 2025, we plan on changing our focus with our company a little bit from what it has been in the past. We really want to improve on our customer service, which is good, but we want to make it better for all of our existing clients. And so we're going to be changing our focus to how we can improve the customer experience. And we're going to do some concrete things to actually try to improve that. One, we're going to actually create some efficiency within the company. For example, if we have a client that has maybe a buffered index that needs to be renewed, or maybe an annuity that needs to get refinanced at a higher rate, we will have advisors reach out to those clients. And it may not be me, it may not be your primary financial advisor that's doing that. It's going to be someone that's another advisor here in the office that can handle some of the easier tasks, so we can focus in on some of the more difficult retirement planning and income planning and developing asset maps and tax reduction and the other things that we do. One of the other things we're going to look at is installing minimums. So we've now installed a $50,000 minimum for any new clients that come on board. That will not affect anyone who's already a client. They will continue to be clients, but going forward, we are going to have minimums in place, and it'll probably go up from there. 50,000 is where we're going to start. And anyone who has less than 50,000, we're going to put together a little bit of a game plan, a written game plan that we can give that person to say, these are the steps you need to take to get to $50,000. And once you get there, then we can take over some of the management on the accounts. And of course, finally, the most important thing we did, which was last year, and it's really coming to fruition now, is we hired a new director of operations, Alan Bunce, who's done a great job really organizing the office, making it more efficient. And with all his experience from TD Ameritrade and Charles Schwab, it is really producing great results in the office. And so we're looking forward to becoming even better at customer service here at Copley Financial Group. So first, I'd like to talk about the new Trump administration and what we're seeing. One of the things that I am excited about is this DOGE, D-O-G-E, Department of Government Efficiency. The last thing we need, of course, is a new government department, but in this case, it's a department that actually is going to try to make the rest of government efficient. I like that. I think it makes sense having the right people in place. And the reason I think this is so important is there's been a lot of waste in government. Just in the last few years, we've seen over $100 billion spent on putting in, for example, internet cables to provide high-speed internet to rural households in America. But the problem is they never installed one piece of cable. It was all billions and billions of dollars spent on the planning of doing this. And then when you start to think about it and you say, well, gee, we have Starlink now. Why are they spending billions of dollars running cables when they can just pay to have Starlink put in and allow for rural communities to have Starlink internet access? It doesn't make a whole lot of sense. The technology is there to improve upon what's already there, not go backwards and spend billions of dollars, and essentially they spend it on nothing. Also, we've seen, for example, the chargers, the high-speed electric car chargers. They spent $7 billion to put in all these high-speed chargers. They got 4 chargers. $7 billion for 4 chargers. So this is an example of government waste. One of the other big things is, of course, war. Looking at what's going on in Ukraine, the Middle East, war is a problem. War creates a lot of waste. And people might say, well, gee, looking at war, you're going to have to rebuild Ukraine. You're going to have to rebuild the Gaza area, the LA fires. That's all going to create economic activity from rebuilding. But this is an absolute fallacy when you look at how economics actually works, because what you don't see is what economists call the unseen. And Frederick Bastiat talked about this in his book. It's also called the broken window fallacy. So this is, for example, if something is broken and we have to fix it, yes, it creates a job for that person or that group that has to fix that. But what we don't see is what would have been built had that window never been broken, or those fires never took place, or that war that would have never happened. And so the prospect of peace, I think, is really, really powerful. A lot of people mistakenly think that World War II saved us from the Great Depression, and that's absolutely not true. World War II was a horrible depression. They had all kinds of rationing for sugar and different food items and gasoline, all these rations in place. It wasn't until after the war, and a president who was very brave at the time, President Truman, he actually slashed government spending by 80% in his term after World War II. And what happened is, and there was a lot of people that pushed back on this. A lot of economists saying, oh, you can't do this. All these people are working for the government, the military. They're creating tanks and bombs and planes and bullets and all this stuff. We can't possibly just let all these people go. We have to find jobs for them. But Truman actually let all those people go and let the free market work, and it worked beautifully. In the 1950s and 60s, all those people started making washers and dryers and new automobiles and refrigerators and televisions and all kinds of stuff, and people started going on vacations again and going to sporting events. I mean, we didn't even have the Olympics during World War II because it was canceled. So all of these things that improve our lives, make our lives better, when we get rid of the government being part of that, spending all this money, let the free market do it, it ends up working out much, much better. So that efficiency in the government and that efficiency by not wasting money, I think is a real positive. Now, I think there's some real potential negatives with some of the stuff that Trump is doing, but as far as the efficiency, I think that is very, very positive. One of the other things that I hope comes to fruition, and I say hope because politicians promise a lot of things and oftentimes they don't deliver. And of course, you got to go through Congress and the Senate and everything else to make things happen. But one of the promises that Trump had was no more taxes on Social Security. This would be a tremendous benefit for retirees, for our clients. It would also mean that everyone who took our advice to do the Social Security the right way, they're actually going to do even better, because we had planned on Social Security being taxed at a lower level than IRAs and pensions and annuities. But if it's not taxed at all, it's going to become a much more valuable income stream in retirement. And recently, even before Trump took office, it was a bipartisan bill that was passed. It eliminated the government pension offset called the GPO, and also eliminated the windfall elimination provision. These are the reductions that a lot of government workers received that were collecting pensions. That these are the reductions they got on their Social Security checks. And so that has been eliminated. That's going to allow a lot of our clients that are collecting government pensions, like state teachers, to actually potentially get Social Security that they didn't qualify for before. So all of those things are things that are going to improve the lives of our clients. And so I am optimistic. Again, I don't trust politicians. They always say, no taxes for you, no taxes for you, no taxes for you. But then we like to see what actually happens when we get into office. But I am optimistic. As far as the economic data that we're seeing, it's really mixed. In even the data that's negative, some of the data on manufacturing and some of the data we're seeing on inflation that's not quite as good as analysts expected, it's not that bad. And some of the employment data still looks pretty good as far as the jobs numbers. And so the data is really mixed. Of course, we recently saw the big crash in Nvidia, which was the company making all of the chips for all of the artificial intelligence. They have a new competitor out of China called DeepSeek, and this company actually is doing some revolutionary things when it comes to artificial intelligence. I always wondered how they're going to actually produce all this excess energy that's going to be needed to do all this artificial intelligence and the data centers and the whole bit. And so one of the solutions is what this DeepSeek company has actually developed. And I bet there's a lot of people in Silicon Valley that are kicking themselves right now thinking, why didn't I think of that? What they did is something really unique. So when we look at artificial intelligence, the companies that we have here in the United States, like OpenAI and ChatGPT, these kind of companies, what they did is they built training models where the artificial intelligence basically trained on the entire internet, learned everything there was to know about the entire internet. And so when you run a search, they're searching through everything, all of this information. Now, of course, maybe I've watched too many Terminator movies. I don't know if it's probably a good idea to have a computer that looks at everything. But what the Chinese did is something unique. What they did is they created experts within the AI system. So when you do a search on the Chinese system, essentially what happens is if you're searching something regarding engineering, they're going to ask the expert on it in engineering, and they're not going to have to worry about searching for anything about the best skiing spots in the Alps. So it's really important to understand when you're searching, it takes energy. It takes a lot of energy and power to run these data centers, to do these calculations. And when you can limit those calculations to an expert within that artificial intelligence system, it really saves the power. And so what they're seeing is they're getting almost as much benefit as far as the computational benefit, as far as the what comes out of the artificial intelligence, but it's using 20% of the power. This is a really big deal, and they've shown that they can do almost the same amount of computational power with chips that are far, far less expensive than the ones that Nvidia is selling, which obviously could really affect their stock. And of course, as you know, I talked about this several months ago, and I was adamant that Nvidia was overpriced and something would happen. I didn't know what it was. There'd be competitors that would come in and kind of wreck their business. We're not going to keep 80% profit margins forever. Well, we're starting to see that. However, I don't think it's nearly as bad as the initial market reaction. We saw a big drop, 17% drop in Nvidia stock in one day. I still think the AI is real. You're going to see a big, big growth story out of artificial intelligence going forward, and we're going to need those fancy chips. In fact, I think it's just going to be an excuse for the people in Silicon Valley to go back to the drawing board, create even better systems, create even better AI systems, and they're going to need those chips to run some of those more advanced systems. The one thing, though, that I cannot sugarcoat is the fact that the market is expensive. When you look at all of the metrics, historical data, looking at whether the stock market is expensive or not, it is clearly expensive. Whether you look at a P ratio, PEG ratio, when you look at the CAPE ratio, it says it's expensive. In fact, the CAPE ratio at 35, that is a very, very high number. Now, the CAPE ratio hit 35 in 1998. And the stock market kept going up for another year and a half before it crashed in the year 2000 during the dot-com crash. However, it is expensive. Of course, one of the big indicators that everyone looks at is the one that Warren Buffett said was the best indicator for stock market, whether it was cheap or expensive, and that's market cap to GDP, which again says the market is expensive. So looking at all of these numbers, it makes me really think about, should we be being more conservative right now with our investments? Should we be hedging against risk? And yeah, that's why we're doing it. That's why we're doing it with all of our clients. Some of these, accounts that we have that are up 20%, we've got all these hedges in place, and some of our clients might only be up 11 or 12% when some of their positions are up 20. That's because I don't have a crystal ball, and I don't know when this thing's going to come down. And when we look at how expensive the market is, it's something that I'm concerned about, and you need to have those protections in place because, again, we don't have a crystal ball. We don't know when it's going to go the other direction. And looking at big picture numbers, just to throw out some big numbers for you to really understand the size of this market. The population of the United States is about 4% of the world's population. We have 4% of all the people on the planet. And those 4% actually produce 16% of the manufactured goods in the world. Those 4% produce 16% of the world's manufactured goods. So when you look at those numbers and you say, we're pretty productive. That's right. We're some of the most productive people on the planet. Everyone says that, China, makes everything and they produce all this stuff. Well, they also have a lot more people. So when we're looking at manufacturing, we are a very strong country. When we look at the gross domestic product, the GDP, we're actually 26% of the world's GDP. Very, very big number. And so this includes a lot of the service industry and the other things that are going on in the United States besides manufacturing, which obviously we have a lot of influence on the world when it comes to computers and other service-oriented things within the economy, like entertainment, things like that. And so, we would expect to have a pretty pricey stock market because we're producing a lot of stuff. We're extremely profitable. But when we look at the total value of all the stock markets around the world, we represent 67% of the entire stock market. 67% of the entire value of all stock markets in the entire world are right here in the United States. That is a really big number. That number is very, very big compared to our GDP, compared to our manufacturing base, and compared to our population. But the real problem with that number is when you look at that 67%, 35% of that number is just 7 companies. This is a big bubble. You don't see this too often. It's called narrow breadth within the market, within the economy. And so this tells me that the market is very expensive. And when we see this kind of narrow breadth and we see these kind of numbers, it often coincides with tops in the market before we have a significant pullback. Now, if we get a significant pullback, I'm not too worried about it. First of all of our clients are hedged and protected against that. And so if the market goes way down, we won't be down nearly as much as everyone else that's out there in the market. But I also understand that it's going to come back probably pretty quickly because with the Trump administration in office, they don't want to see the stock market go down on their watch. And so what's going to happen is if we do have a pullback, I think it'll be probably pretty temporary because I would expect a lot of stimulus to crank that stock market back up, which means that we would have a lot of inflation, which is something that we have been prepared for. And one of the reasons we have heavy positions in gold, which has done extremely well over the last year. We want to keep those inflation positions on. Even if we're worried about a recession or the markets coming down, which would be temporary, we know what the response to that would be. One other concern that I have is when you look at not just how expensive the market is, I also like to look at signs of a bubble, signs that maybe things aren't quite right. And normally when you are in a bubble market, when the stock market is really high and we have high valuations, we see really strange things happen. In fact, one of the first ones to ever happen was in the 1600s. It was called the Dutch tulip bulb mania. And this is when flowers, I kid you not, tulips, if you've never heard of this, flowers were being sold for what the equivalent of about $100,000 to $200,000 today, in today's dollars. They were buying flowers. These are flowers that literally die and wither away. They were buying flowers at ridiculous prices. This happened in Holland. It was a complete mania, a bubble, a Ponzi scheme, whatever you want to call it. The prices on these things went way up, and the people that bought in at the top lost all their money. This was considered one of the very first kind of stock market mania bubbles that took place in history. And that was followed about 100 years later by an even bigger one called the South Seas Bubble. This was a bubble that took place in the early 1700s. And there were companies like the South Seas Company. There was another company called the Mississippi Company. So these are companies that were expected to make lots and lots of profits because of all of the ships from Europe that are going all over the world. They're getting spices and they're getting this and they're discovering that and they're making all this money with all the new shipping that we have around around the world. And a lot of people poured lots of money into these companies. In fact, one person who's a famous person who poured a lot of money in, he actually lost the equivalent of millions of dollars in today's value dollars at the time. And he happened to be not just the smartest human being alive at the time he was alive, but he's arguably one of the smartest human beings to have ever lived. This is the guy that invented calculus. He actually invented calculus in his spare time while he was going to college. He ended up developing it all, and obviously he put this out in a book years later. And this guy was so smart that he developed calculus in order to, because he didn't have any way to look at how the planets and the moons went around the planets and determine how this actually worked. So he developed the math on how this actually works. Well, this guy lost millions of dollars in the South Seas bubble. And of course, you all know who that is, Isaac Newton. And so Isaac Newton lost a fortune. So you could be the smartest guy in the world and still get caught up in this greed and mania that happens with various bubbles that are out there in the economy at any given time. And of course, we've had lots of other bubbles throughout history. We had the big railroad stock bubble in the 1800s. There was huge crashes in the railroad stocks. Everyone got all excited and were buying into these things. And of course, in 1929, we had a giant bubble, and a lot of that was built on the new technology, right? The radio and all this new stuff that's coming out. That was a huge bubble that took place. We also had, of course, the dot-com bubble in the year 2000. That was a big bubble. And there was ones in between, right? In the late 60s, we had the bubble regarding companies like Xerox and Polaroid. There was a big bubble in those stocks that crashed as well. And so looking at the year 2000, of course, you all went through the dot-com crash. We had the bubble in real estate. Of course, we all had these ninja loans, no income, no asset, no job. The minute I saw that, I said, this is a bubble, sold my own house, rented intentionally for several years to wait for the whole thing to crash because it just didn't make any sense. How can people be so crazy to invest in what obviously is a problem? I mean, a flower in the Dutch tulip bulb mania, who would invest in that? Well, today we have something else that is very similar, and I have a feeling this is going to be maybe the next big bubble. And that is recently, we just had $1 billion market cap. This is $1 billion of value, and it was produced by a cryptocurrency that goes by the name of Fart Coin. Yes, Fart Coin, $1 billion market cap. Who in their right mind is buying this ridiculous Ponzi scheme cryptocurrency called Fart Coin, and they think that they're going to sell it to someone that's even dumber than they are in the future? This is obviously an investment that has no value, and this is the kind of stuff that you see. Who in their right mind would invest in flowers? Well, who in their right mind would invest in this digital Ponzi scheme? Which brings up a lot of the other ones that we're seeing. For example, Trump coin or Melania coin. I actually think it's an absolute embarrassment for the President of the United States to issue a cryptocurrency. I think it's beneath his office. I think it's shameful to see him release a cryptocurrency. If you look at the billions of dollars that cryptocurrency is supposedly worth today, he's essentially using his office as the presidency to create this massive Ponzi scheme, in my opinion. Now, there's other younger people out there to say, oh, Matt, you don't know anything about cryptocurrency, and Bitcoin is here to stay and the whole bit. I don't have a real argument. I don't see the value in Bitcoin. I don't see the value in some of these cryptocurrencies. You could potentially make an argument that Bitcoin could have some value compared to these others, but Trump coin, Melania coin, Fart coin, those clearly don't have any value. And so looking at that, it makes me think, is this the bubble? Is this the flowers of the Dutch tulip bulb mania? And so, when you see these kind of signs, you see these kind of things out there in the economy, it makes me concerned. And it's one of the reasons that we want to focus on higher quality value stocks. These are companies that have good free cash flow, that have dividends, high quality value. So we're going to focus on that. We're going to focus on the buffered index portfolios that go up with the stock market, but have big insurance policies in case they go against them. The current one we have is fantastic. It's a 19.25% cap. And so You can make up to 19.25% over the next 2 years. If the stock market's up 15, you get 15. If the stock market's up 19, you get 19. If the stock market's up 40%, you just get 19.25. So you do have to give up everything above that, but I would argue that's still a pretty darn good return, even if the market was higher. But in exchange, you get a 20% insurance policy if the market goes against you. So if the stock market goes down anywhere from 0 to 20%, not only do you get a reimbursement, you actually get the inverse return. So if the stock market's down 10%, not only do you not lose 10%, you make 10%. If the market's down 19%, not only do you not lose, you make 19%. You make the opposite return. Now, if the stock market is down more than 20%, you lose the inverse option and you just get a 20% reimbursement. So if the stock market was down 25%, you would get reimbursed 20% of your loss. You'd still be down 5%. But I would argue that is a very, very good investment, especially today when we're seeing these kind of valuations. I love participating in the market. It's absolutely one of the best places to be for long periods of time. It's a great moneymaker over time. But when you see valuations like this, you want to put those protections in place. And of course, one other protection is just take advantage of the current high interest rates that we're seeing right now. And we still have 5.5% available, guaranteed, insured, 5.5% on a 3-year and a 5-year. That's the multi-year guarantee annuity, the MIGA, which is like a CD with an insurance company. Great product. We also have a lot of other options in the private markets. There's companies that are paying 10 and 12% interest rates. It's something that you can take a look at. You do have to be an accredited investor, which means you have to have $1 million in assets outside of your primary residence to look at some of those private placement investments. They are not insured. They're not guaranteed other than by the company that's offering the product. But we look at these things very carefully. I have a lot of my own personal money that I invest in these. And there's just some really good opportunities out there that may be worth taking a look at if you're an accredited investor that's not correlated with the stock market, where you can get returns that is not correlated to market investments. So with that said, I hope that was a good market update on all the things that we wanted to cover today. We're more than happy to chat with you. If you want to call the office, we can talk to you about some of the things that we discussed today. And I look forward to seeing you in our Mission Valley office very, very soon.